George of the jungle, strong as he can be.
Okay, we're back, and this is part 2 of how to leverage your rate of return on an income property using some seller finance techniques. Thanks for coming into thecreditjungle.com today. This is George Anderson, and if you didn't see part 1 of this video, you've got to go watch that, because what I'm going to get into right now will not make any sense if you haven't watched this. So this is being done in sequence for a reason here. So again, now we're back to the situation where I said, instead of thinking about buying a property, why don't you think about first of finding a buyer, and somebody, again, who has a significant down payment. We're going to say 10% is the minimum on this, and they are willing to sign a contract that might extend for 30 years. And I'm going to explain why they would be willing to do that and why you would be willing to do that as well. So in this instance, the beauty of this is that you don't need to look for the home. You've found somebody who, they have a family, they have an income, they've been providing for their family, they've been saving money, and for whatever reason, they cannot get a mortgage. And I'm here to tell you there are a lot of people out there that are in this situation, that for whatever their circumstances are, they cannot get a mortgage, but right now they're paying somebody to put a roof over their head, and they do not have the benefit of home ownership. So to be able to offer somebody home ownership, in addition to letting them pick the home, okay, that creates some motivation here, and it creates some security and a great rate of return for you that you are not going to have with somebody who's coming in with $3,000 and maybe paying $3,000 a month, okay? It's not their home. They're not going to treat it like their home. They don't have a homeowner's mentality. They have a renter's mentality, and your property is going to look like they had a renter's mentality when they move out of it a year from now. So now we have this buyer, and they've got $55,000, and they get to pick the home. This is a really big deal for them, knowing that they get to pick the home. So now at this point, you are not going to be a landlord, you are going to be an investor, okay? Now, I'm not going to dive into all the details on this, but essentially, the real estate agent is going to take them and show them the house. This money is going to be deposited in escrow with a title company, basically as their good faith demonstration that, yes, when we find a house, we are going to release all of our money back to the investor here as, you know, basically an assurance that we're going to follow through on the contract. When the agent finds the home, guess who is going to be the buyer who's going to be on title and get the financing? If you're the investor, this is going to be you. So you're still buying the home and getting the exact same terms you would have previously. $500,000 purchase price, $100,000 down, $400,000 loan, interest rate of 4.25%, and here's your payment. Okay? Here's what the other side of this transaction looks like now. You are going to, now this is a hybrid seller finance agreement that combines elements of a lease option agreement and a contract for deed. Now the beauty of it is that this is perfectly legal with the lender because you are going to remain on the title to the property. You're not transferring title, you're not doing an all-inclusive trust deed, you're not doing anything that would trigger anything with the tax accounting department, with the insurance or anything like that. Okay, so this is a perfectly legal transaction on any type of loan that you're getting here, but we're talking about a conventional loan because we're talking about investment property. You are going to give this buyer an opportunity to purchase this home over the course of the next 30 years at a 10% premium. So their purchase price is going to be $550,000. They've got $55,000 to put down. Now, rather than calculating what rent would be based on fair market rent, you're saying, okay, look, you're going to have a payment that's going to be an amortizing 30-year fixed interest rate payment, just like you have, and their terms are going to mirror yours, okay? Except that they're financing a little bit more. They're financing $495,000, and their interest rate is going to be your interest rate plus a premium, okay? Now, you got to, this is what you negotiate with the buyer on this so that everybody's happy with what they want to do on this. But in this example, I'm using a premium of 2.5%. Your rate's 4.25%. Their rate's going to be 6.75%. Their payment is going to be $32.10 per month, about $200 a month more than what you would be getting in rent. Why would somebody be willing to do that? Why would they be willing to pay more? Again, it's ownership. Okay? Why would they be willing to pay 10% premium for the property? Again, because they have an ownership interest in this house. And the way that the contract is put together, okay, you cannot take out a second mortgage on the house. Okay? The way that the contract is recorded against the property, it's going to prohibit you from doing that. You can't collect their payment and then not make yours. Their payment is going to go to a third-party escrow company who is going to receive their payment, cut you your cash flow, and then they're going to send the mortgage payment off so that this buyer doesn't get into what's called an equity skimming process where you collect their payment but you don't make yours, and then you've collected their money and all of a sudden now they're getting foreclosed on a home that they thought was theirs. So this is all set up to protect the interest of the buyer here, but in the process of doing that, you're also creating a great benefit for yourself. And again, when these contracts are put together correctly, you are not under the landlord-tenant statutes in the state of Utah. So before we get into the numbers on this, let's just rehash this, okay? So in this scenario, you're looking for a buyer, not a house, okay? You are selling the home and offering a 30-year contract on what I think here everybody can agree is a fairly modest markup or premium on this, and then they get some terms that are going to mirror your mortgage on that. So in other words, when they make a payment and their payment's higher, well, guess what? They've got a chunk of that that's going as a principal reduction. Just like you have money going against principal, they have money going against principal. So this is a great deal, and there's a lot more buyers out there. There's a lot more people that fit this side of the equation than fit this side of the equation. So just shift the way you think a little bit about how you want to approach acquiring investment property, and then we'll come back with part number 3 on this. Thanks for coming into thecreditjungle.com today. This is George Anderson, and we'll be right back.